Ladies and gentlemen, boys and girls, I am interviewing and working with and chatting with another gentleman, David Jaffe. This is the Real Life Trading Podcast, and we are working on and interviewing and discussing amazing topics with incredible people. And David has the very popular YouTube channel, Best Stock Strategy. Just posted a video not too long ago called Trading and Making Money During a Recession. And I want to chat with you, man. I want to learn all about what you do, your world, and how we can enrich lives together.
Yeah, definitely. I'm very honored to be here.
Yeah, likewise, man. Tell me how you got started in trading.
I was always interested in trading and making money. I went to an Ivy League school, and then my dad kind of pushed me towards being an investment banker. I think he always wanted to be an investment banker, but he didn't have the opportunity. And I went into it just kind of like to please my father, but unfortunately, they treat you very poorly while working as an investment banker. And I know that I forgot the girl's name, but I watched the interview that you had with that girl who also worked as an investment banker. So I did that for about 5 years. I worked at CIBC World Markets. I worked at M&A Boutique, Pesky Prunier. In college, I interned with Morgan Stanley. So I was always like close to the market, even though investment banking we don't like press the buy button or sell button. We're more like structuring transactions and like doing IPOs and things like that. But I always enjoyed trading, but I kept losing money from doing things like, just taking too much risk and just basically engaging in behavior that would have like a negative expectancy. So around 2010, 2011, I started selling option premium. And the thing I liked about that was when you sell option premium, you're essentially turning yourself into a casino, you're turning yourself into an insurance company. So you're able to win a small amount of money with a very high probability. It's not completely out of the ordinary where you can win up to 99% of your trades. Sometimes you can go an entire year where you can win all your trades. The problem is that you always have to hedge that tail risk, and you have to make sure that when the actual volatility is more than the expected, that you make sure that you have the appropriate knowledge and the appropriate strategy to make sure that you don't give up all those prior wins from a few outlier losses.
Yes, absolutely agree, man. You're talking my language right now because I know a lot about credit spreads and option selling. So are you more of a math-based trader or technicals, or do you blend all of them together?
Yeah, I kind of blend them. What I do is I look at price action. I think that price is king, and it's very difficult to factor in everything that comes together for like the price. So like I said, when I was working as an investment banker, we would look at like fundamental analysis, and we would look at like the last 12 months cash flow, and then we would go out and then we would look at comparable analysis and see how to price it. But with the stock market, there's so many different influences from like the financials of that specific company to the current market to like the political landscape, where I really look at price action, and then I choose a strike price to sell that I don't believe is going to end up getting challenged. And then I look at the available premium on that option, and I ask myself, do I feel that I'm being compensated enough for my perception of the risk that I'm taking? Because I want to make sure that even if I'm wrong, like today when we're recording this, I believe it's January 5th. Earlier today, the S&P was actually up, but then lo and behold, the S&P actually closed down around 92 points today. And actually, I think at about like 1 p.m., the S&P was just down around like 20 points. So you have to make sure that you have a plan. And even when you're wrong, you have to make sure that you're able to make money.
I'm writing down questions, man, because I'm always here to learn from individuals who have done this for a long time and have been profitable with it. Do you use any indicators or moving averages to help you?
I don't, but I look at VIX and VVIX a lot. So during periods, like usually the market will have like a little bit of a tell, where if you see like a big spike up in volatility, and I look at the S&P volatility, so I look at the VIX, which is the volatility on the S&P 500 index, and then I also look at the VVIX, which is the volatility on volatility. Basically, the VIX tends to be range bound between anywhere from about like 14 on the low end to about like, I mean, it got all the way up to like 84 in March 2020, but around like 14 or 15 on the low end, to generally speaking around like 35 or 40 is where it tends to like live. But it tends to trade, I think about like 75% of the time, I don't remember the exact statistic, between about like 14 and 20. You know, even like lower, sometimes between like 12 and 20, it tends to spend the majority of its range. So I look at the VIX, I look at the VVIX to make sure. When I'm looking at VVIX, I'm just looking at the deltas. So if I see one day that VVIX spikes up by like 10 or 15 points, then that's a warning to me to make sure that I ease up on my trading and that I don't trade too large. And then I also look at specific price action for individual underlines. And by combining volatility with looking at the price action and getting comfortable with the trading range of specific stocks, then I'm able to trade profitably.
Nice. Okay. Do you have a certain number that you use on the VIX to sell more at?
Yeah, that's a great question. When the VIX is low, I tend to sell less. And I tend to be less active. And and many people think that that's a little bit counterintuitive because they say, well, if the VIX is low, then that means that everything is great and there's not much volatility, and therefore you should be selling premium. But the problem with that is when you're selling premium when the VIX is at 15, you're not collecting nearly as much premium as you would during periods of higher volatility. And also when the VIX is at 15, your risk is to the upside. And there have been numerous times, I mean, even today, I think the VIX was up 15%. There have been numerous times over like a 2 or 3 day period where the VIX will go up like 50% or 60 or 70%. I think even in September of 2020, there were like 2 days or two periods where the VIX went up about like 50% in just a few days. And today it was up 15% as well.
Yes. You are correct. Do you have a preference, bullish or bearish credit spreads?
What I like to do is I like to sell puts. So yeah, I generally would like to sell bullish credit spreads. However, you know, the issue is we've been in a bull market for a long period of time. So I'm okay with selling call credit spreads. The problem is that you're not going to collect as much premium because the velocity of risk is going to be to the put side, where it's always like that saying where the bull takes the elevator up, or no, the bull takes the escalator up, but the bear like jumps out the window. So the velocity of risk is to the downside, where it's like the bull takes the escalator up, but the elevator down. And if I'm going to sell credit spreads, I'll like on the call side, I'll sell them when I believe a stock is overbought, and I'll go further out of the money. And I'll also be okay with having that call credit spread get challenged, because I do know that if I roll that call credit spread, there's a very high probability that it's going to be profitable. And I don't necessarily have to be concerned about the tail risk unless I'm dealing with a stock like Tesla, which, you know, just on Monday, it was up, I think like 13%, and it's since pulled back over the past 2 days. But yeah, like generally speaking, the stocks don't have much tail risk to the upside unless it's like a Tesla or like a GameStop or something like that.
Got it. Okay. That's super intriguing, man. So speaking of the stock that you mentioned, do you have any particular company or sector that you really focus on?
Yeah, I want very liquid, some of the largest companies in the world with strong brands. So what I generally do is I'll have like 15 or 20 stocks on my watch list, and then I'll just scan them a few times a day, and I'll look for times when those stocks are like oversold. So for example, like Amazon has spent the majority of the past like 6 months trading between like 32 and like 3,700, or even like 33 and 3,700. So right now when Amazon is trading at, you know, around like, maybe it's around like 34, like slightly below it now. I think that it's trading at the low end of its trading range. So therefore, it would be a good time, especially with volatility higher now, because it's close to 20 since the market sold off tremendously today. You can sell like a 2,600 put or a 2,700 put on Amazon. And especially if you're using portfolio margin, it's not going to use up that much buying power. And then you can collect a decent amount of premium. So stocks like Amazon, Microsoft, I believe, is also a decent opportunity now. PayPal is also a decent opportunity, even though it's been pretty range bound over the past 7 weeks, because about 2 months ago, it fell from like 228 to about 202 after it reported earnings. What else is good? I mean, Nvidia is a good opportunity now. Adobe is also pretty good. It's selling like the low end of its range. I think it got downgraded today, and then it sold off like over $30. So all of those stocks, I like. Look, I want to make as much money as possible, but at the same time, I want to make sure that I'm trading large cap stocks that are very liquid, and that if the market pulls back by 10 or 15%, I don't want the stock that I'm trading to get cut in half.
Yep. And we're looking at Adobe right now, which is super, huge sell-off last few weeks, down 25%. And a lot of the names that you mentioned have markets getting kind of hit right now. And it's surprising that the VIX is not as high as we think it would be, with a lot of stocks really selling off. I mean, it was up a lot today, but right around 20. It's kind of intriguing, huh?
It's so funny you said that, because I said to in my trade alerts, I said, wow, the S&P is down 92. Like, you would think that the VIX would be trading at about anywhere from like 24 to 26, but the VIX is, I think it's below 20. It's like 1976 or like 19 something. So I was like really surprised at that. Like, usually you would see a bigger increase in the VIX. Also, if we could pull up the chart for Nvidia, I think that that's interesting. And I'm not like a chart person, but I do know like Nvidia went from like 225 to like 325. And one of my students asked me about that. And my concern is that, from my experience, generally when a stock goes up from like 225 to 325, it has to pull back and fill in that gap. And my concern is that even though right now Nvidia might be a good opportunity, my concern is that it could fall all the way back to, below like 240, and it could still be like, and it could still like have that structural integrity of all its trend lines. Is that like, you're more of a technician? Am I reading that correctly? What are your thoughts?
Yeah, man, totally agree. So what's intriguing is with Nvidia, I mean, such a huge move. I'm really interested in this guy right here. So this is generally referred to as like an exhaustion gap almost, because you had some nice gaps down here, kind of like a continuation gap, maybe another continuation gap, and this gap 3-4 days and then it fills. That's a little scary. So with these lower highs coming in, the immediate sell off, I mean, obviously very strong company Nvidia is, but it has been on an absolute just tear, man, since, I mean, really March of COVID. I mean, it had a split. Look at this. Right now, 455% up in the last year. So this is a lot. So yeah, the structural integrity on Nvidia is sound fundamentally, but technically it needs, I think this could easily pull back to 236 personally in the next 3-4 months.
Because it needs some time to breathe and digest its previous gains, right?
Precisely.
Yeah, I agree.
Yeah. How long do you normally sell your options, David?
Okay, that I generally do it about like 3 weeks out to anywhere from like 21 days to like 90 days. I mean, it really depends. So during periods when like the VIX is really high, like let's say at the end of this week, like tomorrow and Friday, if the VIX spikes up to like 30, I actually want to sell pretty much as many expirations as possible, because the higher the VIX is, the more premium I'm collecting. So as a result, I want to sell further dated expirations because I'm getting paid for my time. During periods when the VIX is low and the VIX is trading at 15, I actually don't necessarily want to go further out, because then I'm going to be exposed to the volatility expansion. And even though with further dated options, the volatility risk is less, the option varies less the further the duration. The problem is that if that position does actually end up getting challenged, it is much more difficult to roll and to manage a trade that has a larger days to expiration than one that has a shorter days to expiration. So in general, if the VIX is relatively low and trading at about like 15 to about 18, I tend to trade about 3 to 4 weeks, because I don't want to go too far out where I'm collecting a little bit of premium. But when the VIX is higher, then pretty much it's fair game to sell like any expiration.
Okay, that's fair. And so you mentioned rolling. Is that your hedging? Uh, is that the way you protect yourself, or is there other methods you use?
Yeah, I think that some of the ways that I protect myself, probably the biggest one is making sure that I trade small. And then the second biggest way that I protect myself is make sure that I'm only selling puts on stocks that I perceive to be oversold. So if there's a pullback in a stock about like 10 to 15 to 10 to 20% off its recent highs, then I think that that is a decent opportunity. So you'll take that stock where its current market price, and then you'll sell an out of the money option that's anywhere from like 10 to 20% even below that. So basically the stock would have to fall, 30 to 40% from its recent high in order for you to get challenged. And then if it does get challenged, you can then extend the duration on that stock, roll down the strike. Or if you wanted to take ownership of the stock, you could do that, and then you can run the wheel on that. That way you can participate in the upside of the stock. Or there are some more advanced strategies where you can buy like an at the money put option, and then you can sell an in the money put option, and then you can sell like short dated cover calls against that. That would then protect your downside risk because you're long that long put. It would also allow you to participate in the upside because of the in the money and the in the money short put. And then also because your risk in that structure would be just the money that you paid for the long put, which is acting as protection on the downside. You can then sell some short dated calls against that to then recapture the money that you paid for the long put.
Mm-hmm. Yep, that makes sense. I mean, so you mentioned the wheel. Do you personally try to take ownership, or do you try to always get out of that option and focus primarily on just option trading?
Yeah, I tend not to take ownership. I don't like doing that, primarily because there's a big capital efficiency difference between taking ownership of stock and then selling options, especially when you use a portfolio margin account. Like PM, when you sell an option, your buying power can be reduced by about like anywhere from 4% to 10% of like the notional risk of that stock, of the contract. So for example, if you were to sell like let's say you were to sell a strike with a thousand strike, $1,000 strike. One contract would be 100 shares, so that would be $100,000 in notional for everything that you sold, for every contract that you sold. If you're using portfolio margin, and if that 1,000 strike that you chose is pretty far out of the money, that could even decrease your buying power by just about $4,000 to $10,000 in total for 100 shares. Whereas if you're using stock and you're going to sell that same 100 shares at $1,000, that would be $100,000 in notional for the stock, but it would actually decrease your buying power by $50,000. And then the other thing is you're actually paying money when you trade stock because you're paying margin interest, whereas when you buy and sell options, you're using leverage, but you're not actually paying any margin interest. So just for like capital efficiency, if I wanted to go long stock or like long an index, I would probably just use the futures as opposed to using stock, because stock is just not capital efficient enough.
Gotcha. Super intriguing, man. What advice do you have for individuals who have a smaller account? Let's say $10,000 or less.
Okay. If you have a smaller account, I think that it's really important to not gamble and not try to hit home runs and not think that you're going to turn like 5 pennies into 5 Lamborghinis, and not try to take, because remember, like your time is probably the most valuable thing. So I think that for someone who has a smaller account, it's really vital to win and to be comfortable with your strategy and to feel like you have some type of statistical edge. Because remember, even if you're able to make like 25 to 35 to 40% a year, that's not huge money when you have a smaller account. But if you're able to do that consistently and you're able to work hard and work like a regular job or constantly add to your account, then maybe you're really young now at 20 years old. But then when you're 40, instead of $10,000, you might be able to grow that to like 500,000 or a few $1,000,000. So I think it's vital, even at a young age, to really build good habits and to find a trading strategy that you feel comfortable with, where you feel that you can replicate it and that it's replicable to the point where even if you win, you know why you won, and it's not just luck. Because what a lot of people do is they'll win a trade And it's really just predicated upon them being lucky, but then they'll attribute that luck to their personal skill, and then they'll try to replicate that, and then they'll end up losing money.
Yep. No, it does, because it's a challenge. It's a struggle when you have the small account and you're trying to make it work. I like what you said about continue adding to it. Have a day job. It's okay. So on that topic, on that subject, David, what would you consider to be a reasonable or feasible account size to trade full time?
We try to target around 3% a month. So I would say like trading full time, it really depends upon where you live. Like I live in Florida, and I know that, so I moved from New York City, and I know that when I initially moved to Miami, an apartment that I was initially renting at like $2,450 in Miami is now trading for like $4,500. So there's like a lot of like massive inflation in many respects. So I think that you would probably need a minimum of about like $75,000. But the problem is that even with like $75,000, or even like 100,000, where if you're going to make around like 30 to 35%, potentially even more on good years, you can make like 40 to 45%. But let's say you're going to target like 35% a year. I still think even with $100,000, you would want to have like an alternate source of income and not put all your eggs in one basket. Because, hey, look, some of the most successful people in the world, they have many sources of income. So even if you have a larger account with $100,000, if you're only going to trade your own account, and even if you're successful, it's going to be incredibly stressful. And, I haven't asked you about this, but one of the primary reasons why I teach is that it adds an extra and incremental source of income and with everyone that we know who are extremely successful, whether it's like Elon Musk from starting multiple businesses, Tony Robbins having multiple sources of income, you don't want to put all your eggs in one basket for anything. You don't want to put all your eggs in one basket for no other reason that it's going to be extremely stressful to you if you're going to be 100% depending upon your trading performance to fund your livelihood.
True, man. It's true. I mean, why, right? Like, why have one? It's similar to if you had one job and the other person in your home could work, but you're like, no, I don't want you to work at all. Not part-time, not full, don't do anything. Even though they had the opportunity to, or they want to. It's okay to make additional money. I absolutely agree.
It's so funny that you say that, and this is like kind of unrelated, but so my wife, she was like previously married, and she told me that like one of the reasons why she, like when we first started like dating, I actually like encouraged her to work, and she was like very surprised because her first husband he wanted to like keep her home and like make sure that she wasn't like exposed to to other people. And I think that's actually like pretty common, where people just try to like control things. And I definitely think that it's important to have like multiple sources of income, try many different things, but also to protect and try to mitigate your stress. Because even if you make a tremendous amount of money, if you have to sacrifice so much of your mental health and a lot of your stress in order to accomplish that, then it's really not worth it. And I witnessed that firsthand by working as an investment banker when I would look at some of the managing directors who were making millions of dollars a year, and they were miserable. I mean, some of them, they were like alcoholics, or they would go out and party. They were like big on womanizing and things like that.
Yeah. Valid point. All right, man. Personal question, kind of. Who are the 2 or 3 best traders that you know and or have heard of? You don't have to have met them in person, but just people that you know
of. Who do I really like? Okay, so I like this guy Carl Dom from like the Real P&L channel, because he's like extremely analytical, and for a young guy who I'm like really, really impressed with. So Carl Dom is great because he does like a lot of back tests. I think he uses the software like eDelta Pro, and he's extremely analytical. There's another guy, like a young person on YouTube that I had a chat with. His name is JC Gilbert. And I'm like extremely impressed with him because he's so young. And I wish when I was in like my early 20s that I would have the knowledge that he's been able to acquire at such a young age. And then there's also this guy, David. I forgot his last name. I think it might be David's son. He runs a website called like The Trade Busters, The Trade Buster, or thetradebusters.com. And he has a podcast, and he's also like very analytical. And one of my friends like told me about him just like 2 or 3 weeks ago, and I went through like 45 of his podcasts at like 2.5x speed, and he's also very knowledgeable.
Love that. What was the young guy's name? Do you remember his name?
JC Gilbert. JC Gilbert. So he's really good. And I had an interview with him. I also had an interview with Carl Dom, and then with David, I have a call scheduled for next week, and we're just gonna like chat. So I would definitely recommend like reaching out to them, or if you want, like I can also make an introduction with you and with them, because I think it would be great for your audience and for everyone's audience to get them on.
Yeah, that'd be great, man. Thank you. That's incredible. I love it. And I think it's a super, I love to go back earlier. You mentioned 3% a month. Slow, steady, compounding, chip away at these goals. That's how we become full-time traders. It's not glorious. It's like any other job, but the cool part is there's so many benefits, right? You get to do it from home, your own work hours. You get to do it from wherever you want in the world. There's no boss, no phone calls, no returns, no customers, no refunds. I mean, the process far outweighs so many other career choices. What's the next 5 years look like for David Jaffe?
Well, okay. So before I discuss like the next 5 years, I definitely agree with what you just said. Like I actually make trades on my phone, and look, 3% a month when you have a lot of people on YouTube saying that they made like 2,000% last year, it doesn't really seem like much. The problem is that if you try to make, like I want to make as much as possible as well, and I would love to make 5 or 6% a month. The issue with that is the higher returns that you're seeking, the more portfolio volatility you're going to experience. And a lot of people, they get into trading thinking that it's going to be easy money and that their portfolio is just going to go up and up, but they don't understand that you can very easily lose money. And I try to do everything possible to mitigate and reduce portfolio volatility. Regarding the next 5 years, so when I left corporate finance, I swore that I would like never get back into it, because I really hated it. It was just, even the people who were like the most successful, like they were so miserable. And also I'm a very simple person. Like I wear the same thing every day. I don't really I actually bought a car for the first time like 6 months ago, because I was living in like New York City and then living in Miami. So I never needed a car. But I do kind of feel like I've been kind of toying with the idea of like opening up a hedge fund. I think that if I do open up a fund, and even if it's successful, it's going to decrease my level of happiness and like make me like miserable. The issue is that you need a lot of money in order to influence policy. And I feel like even though I'm very well off, I don't have the resources at my disposal to influence policy and to make changes that I feel like I would like to make. So it's kind of like, I could like live like a decent life, and but I don't want to look back like 20, 30 years from now and say that potentially I could have done more. And really like the best way to have the necessary resources to make a huge difference, really it would be like, like going forward with like starting a fund, like getting all the returns audited, like, putting together like a confidential information memorandum or a private placement memorandum, and going through that process. And it's kind of weird because I know it's going to make me miserable to do that, because I've been on that end before. So I don't know why I have like any motivation or drive to do it, but I just don't want to have regret.
Yeah. Hey, I can respect it. I've done both. So I know the pressure that it takes, and it has a toll, to manage other people's money, and you have to be there when they call you. And it adds a different level of stress. Some people are amazing with it. I'm not the greatest with that, intentionally, right? My goal is to create freedom for myself and to create freedom for other individuals. And I'm with you, man. I think that does add a certain level of pressure that doesn't have to happen, but we get to make that choice, you know?
I was just going to use that word, which you said, like, it's freedom.
Yeah.
Like, we're having this chat because we want to have it, but
Yep.
you start going towards like the corporate finance or the hedge fund, or, like down that road again, you are going to lose a lot of your autonomy. You're going to have to do things that you don't want to do. So right now, between trading and like running beststockstrategy.com, I pretty much enjoy probably like 75 or 80% of it, and like 10%, like, kind of like going through emails and like, some of like the monotonous stuff, or like proofreading like SEO articles. Like I really don't enjoy that stuff. But that's like such a small sliver. Whereas when I was working in banking and corporate finance, it was like the opposite. Maybe I enjoyed like 10% of it, and I did like 90%.
Mm-hmm. I like that take. There's a certain level of, a lot of people say, oh, if I love what I do, I don't work a day in my life. And I love what I do, but I still think there are pieces of that are work. There's still pieces, you're going to have tough phone calls. You're going to have to make decisions. You're going to have to either fire customers or employees or hire, right? That's still a challenge. There are still things that are work aspects, and it's just, right. Call something as it is, and it's okay, but you get to pick the words you use. You get to pick the creation and the thoughts that you perceive, and why we create those and how we create those. And you get to come out with where it stemmed from, so that you know where you're going and how to alter those beliefs if you need to, right?
Yeah, I definitely agree. I mean, there's so many things. Like, I feel like the more restrictions and rules you have, the less individualistic and free you can become. Like, I mentioned earlier that I tend to wear the same clothes every single day because I have OCD, and that actually caused like a big problem when I was working as an investment banker, where I had to shave like every single day and like look immaculate. And then, I'd have to like dress really nice. And then I remember my managing director, Sanjay Chadha at Petsky Prunier, he like gave me, he thought that like my wardrobe wasn't good enough. So he gave me like a company credit card and told me to spend like, $500 at Brooks Brothers. So I was like, okay, whatever. So I went, and he told me to buy like a few shirts and pants. And then the weird thing was, so I got it like, I got like measured at the store, and the shirts were like kind of tight. And then after like 3 or 4 months, like almost all of them ended up busting at the elbow. And I was like, oh my God, like this is such a waste of money. Like these shirts are like ridiculously overpriced, and they don't even last long. And it kind of just like reinforced that, just be comfortable. But I do understand the pressures of like corporate finance. But yeah, like the more rules you have, the less individual you can be. But look, you're not going to enjoy every single aspect of life. Like in every relationship you have with your wife, with your girlfriend, there's going to be good days and there's going to be some bad days. You're going to agree on some things and you're not going to agree on some things. So every job is going to have some component to it that you're not going to enjoy. And I think the best thing is just to accept that, and either to farm it out. You can get like a VA to help you with it. Or if it's something that's like so important, like your own personal email, where you kind of like don't feel super comfortable like farming that out, then, grin and bear it, or try to reduce the load, or, try to reduce the number of emails you get.
All kinds of tactics and tips and tricks, man. David, it's been an honor and privilege. Dude, thank you so much for spending some time with me tonight.